What's up, you guys? It's Peter here, and today I thought I'd cover the question on which brokerage to open. So we're going to take a look into what are some key benefits of certain brokerages. Also, what are your goals as an investor, because that might change which brokerage that you go with. And then also we're going to look at what are the offerings of some of the individual brokerages, specifically some of the ETFs, some of the mutual funds. So let's dive into it and take a closer look. So over here, I've put together a mind map that basically covers, different items in terms of which brokerage to go with, some of the goals, some of the features that they offer, which are the candidates that are out there, then the bonus features that they can offer. Some brokerages offer certain things, and then ETFs and mutual funds. So we can dive into that a little bit more as well. So let's dive into it over here. So first of all, as an investor, right, we can kind of see, there's two main goals. Are you investing or are you going to be trading? And so what is the difference? Well, investing is generally considered long-term. So that means long-term as in long-term capital gains also. So, gains that are greater than a year old are considered long-term capital gains often. And then here also lifetime investing, so 30 plus years, like a lifetime of investing. Ideally, if you're doing investing for the long term, you're going to want to maybe buy and hold and just hold on to a certain shares or companies or ETFs forever, for as long as you can. We are interested there also in terms of trading or investing into ETFs and mutual funds, and generally that means stocks, equities, bonds. Those are the main kind of things that you're interested in as an investor. Now, as a trader, right, that would be a little bit different, and you would have maybe different needs as well. So as a trader, you might be looking for short-term. So short-term meaning, less than a year, maybe a couple of days, weeks, or months. And so that is generally referred to, especially if you're doing days, you're doing either day trading. If you're doing maybe a little bit longer, a couple of days, or maybe a couple of weeks, or even months, it's referred to as swing trading. Then you're still trading, stocks and potentially bonds as well. Or you're doing options trading, so that's basically a little bit different than buying direct shares. There's definitely a lot here, but the risk tends to go up as well. So leverage is involved. Forex, foreign exchange trading, so currency, from foreign exchange, foreign currency trading, and basically trading currencies against one another. This is definitely more advanced, so I would not recommend that to go into that as a beginner. Futures, commodities, so that means trading oil or maybe gold or other kinds of commodities. Again, not really recommended to go into that as a beginner. But these are sort of different things that a trader might be looking into. So next, we can kind of sort of look at what features a brokerage actually offers. So let's open up the features over here. And I've kind of sort of grouped them together, sort of, what we obviously want out of a brokerage is that it's reliable, that it's got a good reputation. So security is going to be important. We want to make sure that, it's a secure account, secure brokerages, there's security measures in place so that, they're not going to be hacked or anything like that. Also, if something serious were to happen to the brokerage, that they have insurance, right? So that your accounts are insured up to a certain amount. So definitely the bigger brokerages tend to have these kind of things in place. Oftentimes we are interested in some kind of good trading or investment platform. So that means, we want to be able to use it, ease of use from your phone or your tablet, so you can quickly check it, or that it also ties in with other services. Last time we covered personal capital to cover expenses, but personal capital can also track your investments, which you can then see from your phone or website. So a user-friendly website for the brokerage is kind of nice to have, so you can actually access it from anywhere where you have internet. And then I wanted to do a shout out to TD Ameritrade's platform, which is called Thinkorswim as an example. And Thinkorswim is a pretty advanced platform. Now, I'm not saying that you would have to learn this if you want to start, not at all. But if you are going to do more advanced kind of trading, not so much investing, but trading, then Thinkorswim is a great platform for doing all kinds of analysis, technical analysis, and also, probability, statistics, even placing automated trades. There's sections of that in there as part of the platform. So there's some really powerful platforms out there, but again, that's definitely more advanced. So initially, a simple application on the phone or a simple, user-friendly website might just do just fine. Next, Depending on what it is that you want to do with your brokerage account, do you want to use it for an individual retirement account, whether it's a Roth IRA or a traditional IRA or a SEP IRA? An individual retirement account is a special type of account, and most brokerages these days do support that. The other thing then is individual accounts. So an individual account is basically an account where you trade stocks. It's not tax shielded, it's not protected in any way. It's literally an account where you can invest in stocks or bonds or ETFs. And so this is sort of your starting point oftentimes, your individual account. Next, we have some brokerages will support, employer-based retirement accounts such as a 401k. Now, there might be other types of, employment-based retirement accounts, but a 401k is kind of common. And sometimes it's really advantageous to have your 401k and maybe, let's say, an IRA account with the same brokerage, so that you can do some rollover of certain funds from one to another. Now, the difference being that an employment-based retirement is generally driven by your employer. So if your employer has got their 401k with, let's say, a big brokerage like Fidelity, then maybe it makes sense for you to also open your own, either an individual account or an IRA account with Fidelity as well, because that might make rolling over some money from one account to the other account a bit easier. Next, we have also 529. So 529, a college savings plan. I kind of included that because these are some of the common things that people want to do. And it's not just saving, but it's also investing, right? So it's, you can invest with it as well. Okay, let's move on. So what else is kind of important? So this is more sort of the price, price awareness, low commissions on trades. So that basically implies that you're not going to be paying a lot of fees when you buy or sell shares. Now, oftentimes these days, the commissions are down to $0. So you basically pay almost no commissions anymore. So that can then come, so how do these brokerages make money? Well, that can come in a different form, in the form of an expense ratio as part of a ETF. An ETF, or a mutual fund as well. An ETF stands for exchange traded fund. So it's a group of shares, a group of companies that basically are grouped together based off of certain criteria. Could be a broad market funds, could be an S&P 500 index fund, things like that. But basically, we want to make sure that we have access to that. Especially if you're starting out, you might not want to be investing in individual stocks, in individual companies. Maybe it's better off that you're investing in that bucket of stocks, that ETF, that exchange traded fund. And then what we want to make sure is that the expense ratio is fairly low. So we're going to get into expense ratios in a moment a little bit more, but we kind of want to keep it fairly low so that we don't pay a lot and have a lot of friction and pay a lot of commissions, indirectly through these expense ratios on these funds. Next, some other kind of nice things is dividend reinvestment. So sometimes, companies, let's say shares of Coca-Cola or some company like Coca-Cola pays out a dividend every quarter. And sometimes brokerages will offer a DRIP plan, or a dividend reinvestment plan. That's what DRIP stands for. And so, sometimes that is through the companies, or sometimes the brokerage offers that directly. And that's extremely convenient because you don't necessarily have to go and buy new shares with the dividend that is being released by the company. So if you have access to a dividend reinvestment option with the brokerage, then the dividend will automatically get reinvested into, whatever equity that you've received it from. And it'll buy you more shares. And that is how you can get a really positive, compound interest effect, whereby, the dividend gets released, the dividend automatically is used to buy more shares. The next time you have more shares, therefore you will receive more dividend, which buys you more shares, which gets you more dividend, and so on. But you can automate that using dividend reinvestment strategies. So definitely something worth checking out to see if the brokerage that you're interested in offers dividend reinvestments. Next, we have also automatic investment plan. So that basically goes towards the concept of pay yourself first. You want to sort of make sure that no matter what happens, every week or every 2 weeks or every month, a certain amount of money automatically goes from your bank account into your brokerage account and gets automatically invested into one of these ETFs or mutual funds. And if you set it up that way, you don't really have to think about it very much. It's automating, that transaction. And that also takes the emotion out of the equation, because, the market goes up, you invest $100. When the market goes down, you invest $100. It doesn't really, affect you that much. And so over long periods of time, you're basically dollar cost averaging and buying little bits of exchange traded fund or shares of some stock, over long periods of time, but on a weekly or bi-weekly or monthly basis. And so, however much you want to invest, that's up to you, right? I mean, that'll be, however your cash flow allows for it. But it's nice to have that as an option here, the automated investment plan. And so oftentimes that will be linked to a bank account. So it could be a Chase or a Bank of America or a high yield savings account as well, like from Ally banks. So wherever it's coming from, but it's going to need to be linked to your bank. The next option is fractional shares. So there are companies out there whereby a single share is more than $1,000. So for a lot of people that are just starting out, $1,000 to buy a single share, a whole, share, one share, or even two shares, that's too much. So oftentimes brokerages will allow you to buy a fraction of a share. So let's say of that $1,000, you can't necessarily buy that entire share. So the brokerage might say, well, you know what, I'm going to allow you to buy 10% of this share. So that $1,000 turns into 10% of that, which means $100. And that might make it more accessible to a lot of beginning investors. So fractional shares, right, is definitely useful. Also, again, if you have an automatic investment plan and potentially the dividend reinvestment, fractional shares definitely comes in handy, because otherwise maybe you'll need a certain threshold. Let's say, I don't know, it could be $1 or $5 or $20 or whatever, $100, or even $1,000 threshold based off of what that share price is before the share can be bought. So next, another thing that could be useful is if the brokerage offers educational material. So educational material, I've kind of included here a financial advisor in that, but I've said optional. And that is oftentimes I kind of push this under educational material or put it under educational material, because a financial advisor can do a lot for you, but oftentimes that comes into play when you are trying to manage larger amounts of money. Sometimes brokerages don't really care that much if you've got, let's say, the less than $50,000 invested, or even less than 100 or 200 or 300 or even $1 million. Sometimes it's really about finding ways to optimize, whether it's tax strategies, or if it's some other kind of way of investing, maybe with municipal bonds, or maybe with foreign real estate properties, or real estate investment trusts, or other kinds of things that will help with certain tax strategies for you. That's really where a financial advisor can create a portfolio to your needs and to your, like if you're going to need to, I don't know, maybe do some family planning, help you set up a trust, or work together with a lawyer, with an attorney, that kind of thing, to sort of figure out your specific situation. That's definitely more advanced, I would say, a financial advisor. Sometimes you have what is called a robo-advisor, so a robot advisor, which is more about a robot, so a program, an algorithm that is going to configure a portfolio for you. So based off, let's say, how old or how young you are, it can sort of change the allocation and how risk adverse or how tolerant you are towards risk. It can build a portfolio for you. So and with target date funds and so on. So that can get quite advanced, quite complex, but at the same time, oftentimes these services, are available for you for a small fee, and then you should check whether or not they have a fiduciary duty or not. So that basically that means they are working in your best interest, right? They're not just trying to sell you some high expense ratio fund, but instead they're trying to really help you in your custom situation. Now, I am a firm believer in also educating yourself, so I highly recommend to sort of go into some, look into some tutorials, some articles. Now, there are educational materials out there beyond the brokerages, but oftentimes brokerages do offer specific education also for their platforms. Right? I mentioned before the Think or Swim platform. Well, they also come with a whole bunch of tutorials and materials to learn from, so you can learn a lot from that. Next up over here, let's go and have a look at which candidates we've got here. So I've listed a couple, I've listed some of the bigger ones, and then, we'll talk about the other ones too. So Fidelity, Vanguard, Charles Schwab, and you can kind of sort of know that Charles Schwab recently bought TD Ameritrade, and before that TD Ameritrade bought Scottrade. So it's kind of like sometimes if you think, oh, I'm actually invested with TD Ameritrade, right, but they're actually been bought by Charles Schwab. So a lot of the transactions behind the scenes, you know, all the data, all the trades, all of that might now start to go through Charles Schwab systems. I don't know that for sure, but it's good to sort of know that, you know, there's some really big players in the market, and they, you know, offer, they often are, sometimes they own different brokerages. I've kind of mentioned Robinhood here as well, because Robinhood is sort of a new player on the block, right? A little bit younger, you know, founded in 2013, but seems to really be, you know, aiming to get a lot of people trading and investing. So there's also this website here, learn.robinhood.com. And they've done a great job with, you know, providing all kinds of learning materials. So that kind of falls under the tutorials, especially for beginning investors with an easy to use app and an easy to use platform. I think it's worth checking out. Lastly, over here, I've also mentioned the other side. So that's Interactive Brokers, and specifically they are worldwide. So that means that a lot of these other ones, Fidelity, Vanguard, Charles Schwab, perhaps Robinhood as well, you would need to have a US presence. So that means you would need to be a US citizen, or maybe you are a permanent resident, or maybe you are on some kind of a visa, an H-1B visa or an O-1 visa or something along those lines. But you basically have a social security number which links in with your taxes, so that the government can identify you and figure out, okay, these are the amount of, you know, earned income versus capital gains, and they can tax you on that. But you would need to have a US presence, right, in order to be able to open some of these accounts. Whereas Interactive Brokers, right, this one is a global company. So that means if you are, let's say, you know, I'm from Belgium. If you're from Europe somewhere, you might be able to open an account with Interactive Brokers and then trade on a variety of markets. We can kind of go into that in a moment as well and see all the markets that they have access to, but they are basically global. And they have sort of a light version of their platform and a pro version. Obviously the pro version is a little more expensive, but the light version will give you access, you know, if you wanted to start investing into a variety of these markets. Okay, so next we've got some bonus features. So some of these brokerages, they offer some additional, you know, kind of features. For instance, some brokerages allow you to open a savings or a checking account, and the one that I'm, for instance, interested in is the Schwab Bank High Yield Investor Saving Account, because it allows you to do reimbursements on ATM and foreign transaction debit fees. So if I'm traveling, I could use this debit card into an ATM, and I wouldn't have to pay the ATM fees or also the foreign exchange fees either. And that can definitely add up if you're, you know, a traveler, right? So this is definitely an advantage that Schwab offers. So great. Now, in order to get this high yield investor savings account, they do require that you also have a brokerage account, right? Otherwise, they won't necessarily reimburse it. Other features, as I said already, with Interactive Brokers, IB, Interactive Brokers here, that it's internationally available, right? Also, we'll see for a moment, Interactive Brokers also offers some of the lowest margin rates in the business. So margin means that you can basically have a loan and you can use that money that you just lent from the brokerage to invest into, you know, stocks and so on. Now again, trading or investing on margin is more advanced. So again, if you're a beginner, don't worry about trying to trade or trying to invest on margin. You kind of rather not want to do that, because you're basically going to borrow a bunch of money, invest it into the market, do some trades, try to make some money there, you know, doing trading or doing investing, and then eventually pay back your loan. But whenever you do a loan, right, whether it's a mortgage for your house or over here you're going to loan a bunch of money from the brokerage, there is a certain interest rates involved with that. And so a low margin rate is going to be important, especially if you're starting to trade or invest with larger amounts and if you are intending to do that on margin. But definitely something more advanced, you know, so not something you want to do initially. Next, we've got over here easy integration with tax software such as TurboTax or TaxAct. An example of that is TD Ameritrade. So, you know, both of these, TurboTax and TaxAct, they basically, you know, you go into their software, you can provide them with some very specific numbers that TD Ameritrade provides for you, and other brokerages sometimes do the same. and you plug those numbers in, and it automatically goes and looks up the correct tax forms so that it will list all your capital gains, maybe all the dividends that you've received, all of that kind of stuff, and it'll basically shove that into TurboTax or into Tax Act, and it will help automate that process, so you don't have to manually input all your trades or input all your dividends that you've received, because that would be a bit painful to kind of do that all manual. I mean, you can, but it's nice as a feature to have that easy integration. Again, a lot of the bigger brokerages have that kind of option, but it's worth looking into that before you make a choice, right? Then next, bonus features, especially for starting out, low or no investment minimums. So some brokerages require you to have at least, I don't know, $1,000 before you can invest in a certain fund or ETF, maybe $3,000, or generally it's less than $1,000. And some don't require you to have any money at all as a minimum, in terms of you can start trading with $50, or maybe $100 or some small amount, and just to get you started. So yeah, let's go to the next one then. So here, oftentimes the brokerages that we called out here, Fidelity, Vanguard, Charles Schwab, and so on, they basically have their own ETFs and mutual funds. So let's go have a look at these ETFs. So I've kind of broken them out a little bit just to sort of give you a starting point, because there's a lot of different ETFs and a lot of different mutual funds out there to sort of look into. But we're going to be interested in, sort of for now, the equivalent of an S&P 500 index fund, as well as a total market fund. And I'm going to look at these for Fidelity, Vanguard, and Schwab, and sort of see what are their expense ratios, and are there any minimums that you need to invest into. So an example here, a little learning cap, expense ratio of 0.03% means that for every $10,000 that you invest, the brokerage will charge you, right, $3 annually. So that, that's pretty reasonable, right? $3 on 10,000. What is not so reasonable is when this amount starts to go higher than, I don't know, to me, even like 0.2, right? An expense ratio higher than 0.2 is starting to get high. It used to be that you had expense ratios of 1%, even of 2%, right? So 2% on 10,000, that would be $200, would be huge. So we would definitely not want to be spending our money onto these high expense ratio funds, or unless if you have a very specific reason to do that. But so let's have a look. Fidelity over here has an S&P 500 equivalent fund. So it's not an S&P 500 fund, because this is sort of trademarked. It's kind of, they have to pay a license in order to use the S&P 500. So the Standard & Poor's is an index, right? And that basically they have to pay a license to use that name. So they have an equivalent, and notice that they have a few funds. These are new funds since this year. They're called zero funds, and they basically charge a 0% expense ratio. So they have over here the Zero Large Cap Index, the FNILX fund, 0%, and so also the minimums are $0 for Fidelity. So basically you can start investing with $100 in these index funds. Next, we have a total market index fund. So as again, one of those zero funds, so Zero Total Market Index Fund, FZROX, and again, 0% expense ratio, minimum of $0. So great. We'll look at these a little bit, in depth, in a moment as well. But let's go through the other ones too. So this is sort of Fidelity, and then finally, Total Market Index Fund, FSKAX, and it's got 0.015% and a minimum of $0. Now, you might ask yourself, wait a second, you've got here a Zero Total Market Index Fund that has a 0% expense ratio. Great. And here you have another total market index fund, and that has a 0.15% expense ratio. So why, one is 0% and the other one 0.15, or 0.015. Why would you even choose the one that is 0.015? Well, this has to do with automatic investing, in the sense that, for instance, the FZROX fund doesn't necessarily allow for automatic investing. So to me, then the question becomes, well, am I willing to pay, basically here $1.50 on every $10,000 to enable automatic investing, because it's a service, right? I mean, it's not like somebody had to program that functionality, so they had to hire somebody. It cost a little bit of money for them to integrate that. And then there's other things as well with that. But so the main thing here is that this FSKAX allows for that automatic investing that I mentioned earlier, whereas FZROX currently, as of August 2020, does not allow for that. So basically, sometimes it's nice to sort of, have a closer look into which funds are allowed automatic investment before you actually choose a specific fund. Apart from that, they're pretty much equivalent. They're very similar to one another. Okay, let's go to Vanguard. So Vanguard was one of those companies that basically, started with creating really cheap, low-cost ETFs in terms of expense ratio, right? So if we look at it here, the Vanguard 500 Index Fund Admiral Shares. Now, oftentimes, Vanguard has got sort of the mutual fund version of it, right? And that is coming often in the form of Admiral shares. And they have the ETF version of it as well. So you've got the fund on the one side, and you've got the ETF on the other side, right? And so for the fund, you'll need a $3,000 minimum to be able to invest into that. And we can kind of see over here, it's got a 0.04% expense ratio, VFIAX, right? So that's for the S&P 500 equivalent fund from Vanguard. And then we have here the S&P 500 ETF, VOO, and that basically charges 0.03% expense ratio, and there is no minimum. So you can basically start trading that or start investing into that directly without a minimum. Then we've got the Total Stock Market Index Fund Admiral Shares. So this is a very, very famous fund in the sense that it's recommended all over the internet by people that are pursuing financial independence or just overall broad market investing with low expense ratios. VTSAX, right? VTSAX, a very, very well-known fund. With a low expense ratio of 0.04, so that means on every $10,000 you'd be paying $4. So again, that's fine, that's very low. A minimum of $3,000 is required again because it's Admiral shares. If you want the equivalent total stock market ETF, not the fund, but the ETF, VTI, right? VTI will be at 0.03% expense ratio, and there is no minimum. So eventually, once you start to invest into these a little bit more, sometimes there you have the option to roll that over to basically change VTI into VTSAX, because VTSAX will hold some of the VTI holdings inside of it. And also, again, it has to do with the automatic investments as well, right? So that you can set up automatic investments with the Admiral shares because it's a fund, whereas with ETFs, it might not be possible to do that. I also wanted to mention, if you have a 401k, right, you may see, I don't have access to VTSAX, but you may have access to something else, which is called the Vanguard Institutional Index Fund Institutional Shares. So this is for institutions. So for instance, your employer, let's say, maybe your employer has got, a couple of thousand employees, right? So basically they have a lot of people that are working for them, and therefore they can leverage that larger amount. You can kind of see over here that the VINIX is basically the equivalent of almost like a total market fund as well, but the expense ratio is lowered, 0.035%. And the minimum is $5 million. So definitely not aimed at the individual, right? So there's even bigger ones than this one as well, that require like, $300 million to be invested, and you have, like even lower expense ratios. But again, that's because at the institutional level, they are able to leverage the large quantities, the large sums of monies of all the people that they have to be able to, get lower expense ratios. So in your 401k, you might come across a fund such as the Vanguard Institutional Index Fund. Okay, so with Schwab then. So with Schwab, notice that you don't have to have a minimum to open the account, but over here you do need $1,000 to use the account. So, it's kind of cheeky in the way that you can open the account, but immediately you basically need to fund it with about $1,000 to start, investing into various funds. The S&P 500 Index Fund from Schwab here is the SWPPX with an expense ratio of 0.02%, and the minimum that you should invest in that, or that you need to invest in that, is $1. So, okay, fair enough, but eventually you need $1,000 in the account, right, to start actually investing into it. We've got over here the total stock market index fund, right? So that's basically the equivalent of your VTSAX. And this fund, this total stock market index fund from Schwab, is SWTSX with 0.03% expense ratio and a minimum of $1 again. And then finally, we've got the Schwab US Broad Market ETF, which I wanted to include as well. It's a little bit, it's a little bit different. It's sort of large cap, right? So, I mean, we'll look at what is inside of these funds in just a moment, like the holdings, the top 10 holdings in a moment. But you're going to see that a lot of these kind of share similarities. And that is 0.03% expense ratio with a minimum of $1. Great. So that's sort of what I wanted to cover with this kind of stuff. And now let's go and take a look at some of the other things in terms of the like the things that we covered with Robinhood learning. So let's go have a look at that here. So I went to this learn.robinhood.com site, and you can kind of say, okay, your financial journey starts here. And as we kind of scroll down and notice that there's a lot of topics over here, right? Investment basics, and you kind of, start investing for as little as $1. How can you buy some shares? What is the diversification of your portfolio? How should you approach investing when you're in your 20s? So lots of topics, and each of these, basically, if you click on it, each of these, goes into even more, right? So you can kind of sort of, get into it and read up on this and so on. So there's a lot of topics. So I'm going to scroll through them briefly so you can kind of see, about the markets, about, the lingo in terms of the jargon. So lots and lots of topics to sort of look into, and too much to go into here, but this is what I meant with I think Robinhood has done a great job with sort of explaining things in easy to understand terms, like cum laude, macroeconomics, all kinds of stuff, cash flow, super important to understand that. So anyway, this is a little bit in terms of a great example of educational material for a brokerage. So next I wanted to talk briefly about interactive brokers, and specifically here we can kind of see a map, right, of all the exchanges that they support. So we can see here's the New York Stock Exchange. Currently it's closed. Here's the Chicago Board of Options Exchange. This one over here is the Mexican one, so the Mexican Borsa. Here we've got the Spanish one. Here's the London Stock Exchange. Here we've got the one in Germany, in Frankfurt. There's one in Switzerland as well. So, and then here we've got the Asian one. So Hong Kong is here. You've got the Australian one. There's the Indian market as well. So anyway, it supports a lot of these different exchanges if you want to go and depending on which country that you're in or which exchange you want to trade on. We can also see global access over here, your gateway to the world's market. So if we go down, right, we can kind of see over here all the different exchanges and stocks and later on ETFs that we can trade on. So futures, fixed income. So they support, mutual funds, right? If we can go look for some of these here, we can kind of eventually see here, for instance, the Vanguard funds are showing up as well. So, there's so many of these funds, right? So these are all supported, T. Rowe Price, another famous one. So anyway, there's a lot of these, right? And then for Europe as well, right? So that was all the US. So if you want to trade on the European ones, like for example, I'm from Belgium, there's the Euronext, Brussels stocks. You've got, if you're in the Netherlands, right, you have the Euronext in the Netherlands. There's a whole bunch of these, Euronext France as well. So if you kind of want to have access to those exchanges, then you can have access through these different exchanges. So anyway, that's for more international securities, all kinds of stuff for the Asian markets and so on. Forex as well, right, as I mentioned. So and then here briefly I just want to cover margin rates. So again, if you did want to borrow money to sort of invest, not that I recommend it initially, but you can actually do it. So and here you can kind of see the rates that they charge. So for less than $100,000 it's going to be 1.58% plus their sort of 1.5% that they add to it. Now this is for their pro version. You also have their light version, and the light version is pretty much the same no matter how much you invest, right? But the light version is generally used by people, investing less than 100,000. I think if you're really serious about it and you want to go after the pro version, you can kind of see that these interest rates really, or these margin rates, I should say, really start to drop, right? So once you sort of over here go between or over 100,000, you're going to start hitting, about 2% in terms of margin rate. That's amazing. I mean, I don't think any other brokerage offers that. So you can get amazing margin rates here. Once it goes higher, it drops even more. But again, now this is really for advanced trading. Anyway, I thought I'd show this. Next, let's go into the Vanguard funds list. So if you if you don't know what to invest into and you kind of want to have a look, you can kind of do some research, right? So basically choose your fund categories with Vanguard. And as we kind of scroll down here, this is currently under the mutual funds tab. We also have the ETF tab. And so here we can kind of see 62 matching funds. Okay, so there are 62 of them, so that looks like quite a lot. You can see immediately here the expense ratios, right? So pretty low expense ratios. Vanguard's famous for that. We're currently looking at US bond funds. I haven't really talked about bond funds. Maybe when you're a bit older, you might want to have more allocation to bonds. I'm in my mid-30s. I don't really need a lot of allocation to bonds yet. I'm pretty aggressive with my investments, so a lot of equities. So as we kind of scroll down, let's kind of see here what else. You can see the return, right? So the return as of year to date versus 1 year return versus 5 year return versus 10-year return, or since inception. Some of these funds have been around longer than others, and so you can see how long they've been going for. And then also important, the asset class. Is it bonds, is it stocks, is it large cap, is it small cap, all of that kind of stuff. The price, yeah, that's kind of important, but kind of not important, because you can do fractional shares. So again, even if this was $1,000 worth of fund and you only have $100 to invest, it's fine as long as your brokerage supports fractional shares. So I like that they've kind of indicated here with a little dollar sign the one that is the cheapest expense ratio. So you can quickly see, all right, which one is the cheapest one. The total bond market might be a useful one to pursue. Let's go down a little bit and let's have tax exempt, investment grade. Sure. Here we can see balanced funds. So they will do what is called a target retirement fund, and they will automatically rebalance it based off of which target date that you're targeting to retire. And so that will do the automatic rebalancing for you. But notice here 0.13. So the expense ratio for this is definitely a lot higher. So I'd say, this is pretty easy. It's literally a bond fund together with a broad market fund, and you can do that yourself, right? You can basically buy a little bit of bonds. You can buy a bit of equities in a moment. Here we're going to go to the US stock funds over here, right? So we can see the one that I just covered, VINIX, the Vanguard, this 500 index Admiral Shares fund with a low expense ratio. So you take a little bit of the bonds fund, you take a little bit of an S&P 500 funds, and you build your own percentage in your own sort of target date funds, and then you have more control over it, and you end up paying less expense ratio. So that's kind of what I would recommend. So then we have over here the total stock market index fund. So this one that I mentioned, the very popular one, VTSAX, and you can click on any of these, right? So if we were to click on this, it's going to give us a little bit more insight into this specific fund. So it's going to load all its statistics, all of its settings. It's going to say, okay, overview. As I said, the minimum investment of $3,000, expense ratio of 0.04. What is it? Large blend, so large cap stocks. Also domestic stock to the US, right? So this is a US based fund. And as we scroll down, we can kind of sort of see a little bit in terms of risk. Well, it is equities, it's not bonds, so it's going to be higher risk. We can also see the sort of the hypothetical growth of $10,000. So $10,000 in 2010 to today is $35,000. So, definitely it's performed well. We've been in a 10-year bull market. So, yeah, that's kind of what you get there. Next, we can see also the holdings. So this is kind of important, right? So here, what's inside of it, the portfolio composition. So you can see most of it over here, 26%, right, is actually in technology, right? So there's a lot in technology. We've got a lot of financials here, 15%, consumer services, 14%, 11% industrials, healthcare, 14%. So yeah. But basic materials only 2%, telecommunications, right, 1.7%, utilities 3%. So the majority of here is technology, and we can really see that in the top 10 holdings. So the largest holdings over here is number 1, Apple, number 2, Microsoft, number 3, Amazon, Alphabet. So look at this, right? Tech stock, tech stock, tech stock, tech stock, tech stock. Okay, pharmaceutical, Johnson & Johnson, Berkshire Hathaway is a conglomerate, so that's Warren Buffett's company, right? And they are in a lot of different companies. A lot of consumer goods, I would say, are in Berkshire Hathaway's as well. And then Procter & Gamble, right? Also, you know, I don't actually know what that one falls into. Probably also consumer goods. And then Visa Technology again, and United Health is healthcare. So basically, as you can kind of see, a good amount of this, you know, the first top 5 is all tech stocks. So be a little careful with this in the sense that if you think, oh, I'm going to invest in Amazon, I'm going to invest in, I don't know, Visa, I'm going to invest in Apple. And then on top of that, you're also saying, well, I just want to also buy these broad market index fund. Be aware that, you know, some of these actually already have large investments into these tech stocks, right? So over here, 23% is already in these tech stocks. Great. So we can kind of start going through all of these, and I'm going to briefly bring up, let's see where it is, this one. No, we just looked at this one here. So here I've kind of brought that up for the other ones as well. So I'm not going to go through all of them, but you can kind of sort of see that we have information for all of these. So this one is that VFIAX one. Here we have VOO, the S&P 500. And oftentimes it'll state, you know, also available as Admiral shares, right? So this is what I was saying, that you can start with the ETF, which does not have that minimum. And then once you're ready to sort of, you know, you have your $3,000 or however much you need, right? You go to the equivalent. So this would be the equivalent, and it'll need that $3,000, right? And then that'll allow for automatic investments as well. Cool. So VTSAX, that's the total stock market fund, and you can kind of go through and sort of inspect, you know, what are the differences here. I mean, we just looked at this one already in terms of what are the holdings. You know, VTI, the Vanguard total stock market again, right? And so, you know, you can kind of go through, and you're gonna see same holdings pretty much, right? It's kind of like, you know, it's just, is it the index fund or is it the ETF? VINIX, the institutional shares, right? So again, here, if we look at that, same thing, large blend, but $5 million. And if we look through those holdings, same thing, right? Apple, Microsoft, Amazon, but notice 28%, right? So the distribution here is even higher. The other one was like, what, 23 or 22%? Like if we look over here at, yeah, this is about, let's say 24%, whereas the VINIX is 28%, right? So, but apart from that, it's pretty much the same, right? I mean, these are the top holdings that we have over here. Notice here, maybe a little bit different weighting in terms of the financials versus the healthcare, right? JP Morgan Chase coming in versus over here, United Health. But apart from that, very much the same. So that means the behavior, right? The returns will be similar too. Next, we got the Fidelity side of things, right? So here, Fidelity ZERO, right? That zero fund with, there's, you know, new funds that don't have any expense ratios. And it's very similar in terms of, you know, some of the behaviors, and you can kind of map it and see how it behaved. Now here's the top 10 holdings as well. So they have Microsoft, Apple, Amazon, Facebook, Alphabet, so there's Google, right? Johnson & Johnson, Berkshire Hathaway, Visa, and Procter & Gamble. So, you know, very similar kind of holdings. All right, F0X. So this is sort of the total market index fund, right? So again, sort of similar, but you know, similar holdings, but no expense ratios. And you can kind of see here, minimum to invest also 0. You kind of see in terms of other things, the expense ratios 0%. So every single one of these brokerages will tend to have these kind of data sheets, right, with information how the stock or the fund has performed, as well as sort of what are the holdings, what's inside of it, what's the expense ratio, what's the minimum, all that kind of stuff. So same thing, FSKAX, the Fidelity Total Market Index Fund, right? So that allows for automatic investing. The other one, the 0X, at least as of today, does not yet. So yeah, and then same thing here for Schwab. So with Schwab, we can say comparison of Schwab market cap index funds. So I like seeing brokerages offer this because, you know, they're trying to be competitive. So we can see, for instance, here, this is a Schwab Total Market Index Fund, and they're going to be comparing that against the equivalent Vanguard, because Vanguard for the longest time was king of the hill as it came to the low expense ratios. So VTSAX at 0.04, and then obviously they're going to try to, you know, show you that their fund is a little bit cheaper, right? But apart from that, these two funds are pretty much exactly the same. So, and honestly, you know, 0.01% is barely gonna make the difference. I mean, that is the difference of, you know, paying $4 a year versus paying $3 a year. So on $10,000, right, in terms of expense ratio. And you can click on these, right, and so it's going to load, and you can kind of again see the investments of, you know what is the expense ratio. Are there any minimums for this? You can kind of see the behavior. You can see the dividends as well that this fund you know, pays out every quarter most likely. Anyway, you can kind of go into this and sort of, you know, read up on it more. It probably shows you, you know, the 10 biggest holdings as well, you know, the makeup of the fund, you know, all that kind of stuff. Sometimes, you know, some ratings, you know, Morningstar has rated this fund as 4-star, 3-star, whatever, that kind of thing. The risk, you know, above average. So every single one of these brokerages tends to offer this kind of insight, right, in terms of, you know, it's a large cap stock and it's a blend. All right, so if we keep going, right, so here's that same market fund. In terms of, here's the total stock market index fund, and again, same deal, right? So each time you can kind of sort of, you know, gain insight into this. And then same for the ETF. So Schwab US Broad Market, so that's Schwab B fund over here. And you can kind of see how it performs as well, year to date or over. You know, year to date, it's like up 8.5%. If it's, you know, 1 year, you know, it's up almost 20%. You know, 3 years, 39%. 5 years, 79%. So, you know, definitely useful to sort of gain insight into that. So with that, I want to go back to this here, and I just want to show you the overview again. So hopefully this gives you, you know, a little bit of an understanding, right, in terms of, you know, the features, the different candidates, the bonus features, all the ETFs that are available, and whether you're going to be investing or trading. Now, I hope you enjoyed this, and next video, or one of the coming videos, I will open a brokerage account together with you. I will open one probably with Charles Schwab, because I already have Fidelity and Vanguard. So I want to go through the process and open. And so again, the questions that we really need to answer, right, is under the features. You know, does it support dividend reinvesting? Does it support automatic investing, you know, setting up that link to the bank account? Does it support fractional shares, or do they have some equivalent? I mean, they have some other things called slices, you know, all that kind of stuff. Are the commissions low, right? Do they have some educational thing? And so Charles Schwab is pretty good brokerage overall, from what I can tell, in terms of, if I, you know, I've done my research and sort of been looking into that. So that will be the next step, to open a brokerage together. But first, today, I wanted to cover all of these criteria. So hopefully you found this valuable. Let me know in the comments down below which brokerage that you use, or if you think, oh, I should be looking into, you know, maybe one of the new ones that are popping up. There's a good chance that some of these new brokerages are going to get absorbed or get bought by these older, more established, bigger brokerages. You know, that tends to be the name of the game with brokerages often, whereby they get bought out, you know, acquired by, you know, these bigger brokerages. But still, let me know in the comments down below, you know, if you've got certain, you know, features that you think, oh, this brokerage, you know, would be awesome if they have this, or it's lacking that. Let me know. And also, please, if you like this kind of videos, please like and subscribe. And I look forward to seeing you in the next video. Oh yeah, and also hit that notification bell so you get updates whenever I launch a new video. All right, take care. Bye-bye.